Afternoon, everyone. As Liz said, my name is Timothy Downs. I am the Regional Director for North Carolina Economic Development for Thomas & Hutton, and I proudly serve on the NCEDA Board of Directors. I'm excited to be your MC for today's webinar, The Economy in 2025, and we're thrilled to have all of you with us. Before starting the program, I'd like to acknowledge our NCDA's annual sponsors, whose logos you'll see on the screen now. These companies and organizations support every component of NCEDA's expansive mission and our growing body of programs. We thank all these sponsors for their generous support. Webinars that benefit our membership like this one result from their support. During today's webinar, we'll take a deep dive into the latest national and regional economic trends shaping our communities. As economic conditions shift, factors like inflation, employment, demographic changes, and interest rates can have far-reaching impacts, especially for those working to drive economic growth in North Carolina. Our speaker will provide valuable insights into how potential policy changes could influence our state's economic landscape, helping us better understand the opportunities and challenges ahead. By staying informed and proactive, we can strengthen our ability to navigate an evolving economy and support long-term success for our businesses and communities. Now, our speaker today is Laura Ulrich, familiar to many of us. Laura is a senior regional economist at the Charlotte branch of the Richmond Federal Reserve Bank. Prior to joining the bank, Laura was an associate dean for undergraduate programs and a professor of economics at Winthrop University. Her research interests include higher education, school finance reform, local and state level tax and expenditure analyses, and the economic impact of local development. Laura holds a doctorate and a master's degree in economics from University of Tennessee and a bachelor's degree in economics from University of Georgia. And as Liz said, we'll have time at the end of the presentation for questions. You can enter those questions in the Q&A box, not the chat box, but the Q&A box during the presentation, and we'll try to address as many of those at the end. So Laura, thank you for being with us. The floor is yours.
Thanks so much, Timothy. I really appreciate it. Good to be with you guys virtually. It's always a little bit hard to talk to a screen with almost 100 people on it, but I'm really glad all of you are here, and I hope you will ask questions as I go through today. I'm going to go ahead and share my screen and jump right in because there is a lot to talk about. So many of you have probably seen me present before. I've presented to this group in the past, but I am Laura Ulrich. I'm a senior regional economist at the Richmond Fed. I'm located in the Charlotte office. And I am going to give both a national and regional economic update today. And before I get going, I always get to remind people that the views I'm going to express are mine alone and don't represent an official position of the Federal Reserve Bank of Richmond or the Federal Reserve System. All right, so let's start out with kind of where we are right now. 2024 was another year of strong economic growth, stronger than predicted economic growth, and this has really been the story since 2020. Every year since then, 21, 22, 23, 24, have all been years of strong growth, and I'll show you all of this. I'll back up all of what I'm saying right now with data in just a second. Coming into 2025, most of the public-facing forecasts, we don't have a public-facing forecast, but if you look at most organizations that do, most folks were predicting that 2025 would be kind of at least as good of a year as 2024 in terms of GDP growth. I will say, though, there is exceptionally high amounts of uncertainty around that right now, just given all the political uncertainty, policy uncertainty. And so, I do want to characterize that right from the beginning as many of those models were done last year and don't necessarily take all of that into consideration. We are continuing to see slowing in some sectors. There are sectors that have been especially hard hit by inflation. There are sectors that have been especially hard hit by interest rates going up and still remaining higher than we saw prior to the COVID period. But in general, we're seeing continued growth, and that's really driven by strong consumption. Currently, fears of recession seem pretty low, but people are worried. You hear people talking about the economy in all sorts of ways, whether it's about employment or about inflation. I've bet in this week I have heard or read at least 100 things about the price of eggs. People are concerned about what's going on in the economy. But through all the turmoil we've had over the past 4 years since COVID originally hit, almost 5 years, which is crazy, right? It's really crazy to think about. since that period of time, even through all of that, we saw a pretty quick rebound, especially in places like North Carolina, in terms of employment that really was driven by the strength of consumption. And so we'll have to see what happens the rest of this year. Some states have fared much better than others. So if you look at a state like North Carolina, it has fared very well in any measure of economic growth that you could consider. But there are many other states. You could look at places like Louisiana or Mississippi or California or other places in the country where they have not yet recovered to full to pre-COVID levels of employment and GDP. That being said, about North Carolina, there are places in North Carolina that have continued to see population decline and employment decline. So if you look at the growth in North Carolina, it certainly is centered around a few large metro areas, including Raleigh, Durham, and Wilmington. So a lot of this that I'm talking about is geography based, it's industry based. And so one thing I'll show you today is kind of how the distribution of this growth is impacting the state. One second. Timothy, I'm having a freezing on my side. Can you still hear me fine?
You can, yeah.
Okay, good. Okay, I'm glad. On my end, things got very strange, but welcome to technology. Okay.
Yeah.
All right. So the tough thing though right now, I think, from an economic standpoint that has to be talked about is that inflation still does remain above the 2% target. So our goal is to have 2% inflation over the long run, and we're still above 2%. And sometimes I'll joke about the fact that people will say to me, well, we're at about 3% or about 2.8%. That's almost 2%, but really mathematically it's not almost 2%, right? So the fight against inflation is not over. I think there have been signs that we're still heading to that 2% level. It's just the pace of the decline in the inflation rate has certainly slowed over the past few months. I'll show you data on that as well. But if you listen to people like our boss, Tom Barkin, or Jerome Powell, who's head of the Board of Governors, if you listen to people at the Federal Reserve and that are part of the FOMC process, they've been very clear that they are going to work to get the inflation rate back to that 2% target. So I think the question is, how long does that take? What happens to rates in the meantime? And we're going to have to be a bit patient to figure that out. All right, so we're going to start out looking at GDP growth. So this is real GDP growth. So this is the value of all final goods and services produced in the United States in a year. And this is after controlling for inflation. So this takes inflation out of the picture. So it really is kind of the volume of goods and services that are produced in the U.S. And a couple things that I will point out to you. The first is that strong growth that I mentioned during this post-COVID era, with the exception of a couple of quarters way back at the beginning of 2022 that were a little soft. We have had above trend growth since then. And actually, if you look at GDP trend growth, we really are back to this pre-COVID expectations, which is basically like saying we're where we are in terms of economic growth if COVID had never happened. That is really astonishing to think about when you think about the disruption that was caused with everything shutting down, right? People going home and not working, kids not being in school, like all the things that happened associated with that. Pretty impressive, really, in terms of economic growth. On the right-hand side, you'll see the FOMC members' projections. As a reminder, the FOMC members are the 7 Board of Governors. So that group is headed up by Jerome Powell. They are in Washington, D.C. They are federal government employees. And then the other 12 members of the FOMC are the banks of the 12 regional banks, including the Federal Reserve Bank of Richmond, where I work. And those presidents and the employees that work for the Richmond Fed, for example, are not federal government employees. So we're nonprofit bank employees. So the Federal Reserve Bank of Richmond is a nonprofit bank. And they go to these meetings every 6 to 8 weeks, kind of depending on the timing of the year, and they determine monetary policy. But one of the other things they do is every other meeting they make projections on what they think is going to happen to the economy. So that's what you see on the right hand side. The gray bar is the range of those projections across those 19 people, and the red diamond is the median projection. One thing you'll notice about these projections is they're all around 2%. 2% is kind of like good, strong growth in the United States, kind of a typical good year. You might expect around 2% growth. You'll see that no one has expectations that this growth goes negative over the next 4 years. I like to remind people that that does not mean we will not have a recession in the next 4 years. That just means at the meeting in December, when they made these projections, there's nothing in the data that allows them to predict when that might happen, right? There's nothing that says, hey, this year we're going to have a recession, or 2 years from now we're going to have a recession. Our president, Tom Barkin, likes to say nobody has canceled the business cycle, right? So regardless of how strong an economy is, at some point you'll have weaker spots, right? We just don't know exactly what that timing would look like. But of the 19 presidents at the end of 2024, certainly the range of expectations was very narrow, around that 2% bound. No one was expecting a downturn. And much of the story of why we have not had a recession since the very short COVID recession is about consumption. So this graph, this is one that if you've seen me present in the last 3 years, you've seen this graph, and you'll see many of the same ones. You know, I like to tell kind of the same story so we can see how it's changing over time. But this graph is one, as an economist, that still surprises me when I look at it, to think of how strong consumption has been. This is real consumption in the United States. So real consumption, anytime you see the word real, that means it controls for inflation. So the way you can think about this is you can think of it as like a grocery cart with everything you purchase in it. So all the goods, all the services you buy. So everything from groceries to clothes to daycare, paying for a daycare spot or your gym membership, right? All the goods and services. After controlling for inflation means it's really about the amount of stuff you're consuming, right? The amount of stuff and the quality of the stuff. We know over the past now 3 years or more, we've been having a period of unusually high inflation for US standards. Typically, when that happens, when you have inflation and prices go up, unless people's incomes also adjust very quickly, which incomes are relatively sticky, they tend not to adjust as quickly as prices do. But unless they adjusted very quickly, then you would expect to see people consume less stuff, right? The stuff has become more expensive, so I'm going to put less stuff in my cart. Or if they're not consuming less stuff, they would at least consume lower quality stuff. So instead of buying organic milk, they would buy non-organic milk, right? Or instead of going to an expensive department store to buy their clothes, they might go to Target, right? So they substitute down. And during this period, that just has not been what we have seen from a macro point of view. Now, some of you may be watching this and saying, hey, I'm doing that right now, and that may very well be true. But from a macro point of view, that's not what we've seen. We've seen people to continue to buy more and more stuff, to put more stuff in their cart. There's several reasons that are driving this. There's not just one factor. And all three of these things I'm going to point out make this a very unusual period of time from an economic history point of view. You know, I think about this period of time, sometimes my geeky self, I kind of geek out on the fact that one day people really are going to study this era, right? Because it is so interesting. But there are really about three things that I think of when I think of what's driving this. One is the tremendous decline that you see in consumption right when COVID hit, right? So why did this happen? A combination of things. First of all, people don't know what's going on. They kind of freak out, they get a little scared, and they pull back on their spending. So that leads to savings. The other thing is some of the things we bought, you just couldn't purchase anymore, right? At the time, my oldest son was in an after-school program, or my youngest son was in an after-school program that closed, right? So that money that came out of my account every week no longer came out of my account. And so I then had money to either save or spend on other things, right? So in the short run, people saved this, and it led to excess savings. Then what started happening was there was a ton of stimulus that came into the economy. So stimulus in all different types. So there were stimulus checks that went to households. There were PPP loans that companies got to help them maintain employment. State and local governments got money that impacted those of you on the call probably in many ways. You had HERF dollars going to higher education, ESSER dollars going to K through 12. State and local hospitals got money. All sorts of money was flowing from the federal government. That trickles down into income, right? Companies get the PPP loan, Many companies got those loans, or sometimes I joke and call them grants, because you don't have to pay it back, right, in most cases. So people got that money, and then their revenues weren't adversely affected. So the owners of those companies made more money, right? It trickles down to personal income. People spent more money. And then the third thing that really stands out to me is the rise in asset values. Asset values across many classes are up. So if you owned, back in 2019, 2020, early 2020, if you owned a home, if you owned gold, if you owned Bitcoin, if you owned whatever, fine art, probably the value of that is up. People feel wealthier. They spend more money, and so that has also happened. You will see, though, the middle line is services and the bottom line is goods, and you'll see these blue lines. These are pre-COVID trends. So once again, this is like, what would we expect to have happened with consumption spending on goods and services and overall consumption if COVID had never happened? And you can see that in the beginning, goods consumption was up quite a bit. People bought stuff, right? A lot of us did this. It was like, oh, I'm going to be trapped in this house. I want a new sofa. I've got to get out of this house. I'm going to buy a bike, right? We bought goods because a lot of services were unavailable. And so therefore, if you look at inflation, I'll show you this later, inflation in the beginning was mostly based on goods. There were prices, demand goes up for that bicycle, right? Everybody wants a bike, price goes up. So inflation on goods went up. But in more recent months, it shifted to be services. And you can see that here, that now service consumption is quite a bit above that pre-COVID trend. I did want to mention housing because we get out and about a lot. Just in the past week, I was out in Eastern North Carolina. Some of you on this call might have been with me in Greenville. I'm not sure. But I was in Eastern North Carolina last week. Yesterday, I was in Chapel Hill. We're all over both North and South Carolina on our team, learning what's going on the ground in communities. And one thing I will point out, and this is going to be of no surprise to the people in this call that are in economic development, but it doesn't matter where we go, people talk to us about housing. We could go anywhere, and housing is what they want to talk about. Yesterday, the majority of the questions I got in Chapel Hill about housing and how expensive it is there. It depends on where you are, the exact tone of those questions, and the issues that they're dealing with. So if you look at more metro areas, so places like Charlotte and Raleigh, certainly Asheville, it's a story of lack of available land to build, right? The need for greater density and the fight against that, perhaps. Lots of conversation about the affordability of housing because demand is outstripping supply. If you were to go to the more rural parts of the state, of North Carolina or South Carolina, or certainly West Virginia, the conversation might be more about the quality of the housing stock and the fact that there aren't homes for people to purchase, right? If somebody moved into the town and wanted to buy, a family home, 4-bedroom, 2-bath home, or whatever, that the lack of supply is really significant in those spaces. But one thing we can look at to see how affordability is impacting communities is to look at the share of housing cost burden households. So this is the share of households that are spending at least 30% or more on their income every month on housing. So if you spend more than 30% a month, you're considered housing cost burdened. If you spend more than 50% a month, you're considered extremely housing cost burdened. And, I'll point out, if you look here, you can see the counties. This is our entire footprint for the Federal Reserve Bank of Richmond. So we cover the Carolinas, Virginia, West Virginia, Maryland, D.C. And you'll notice that in the Carolinas, there are very few places where the counties are these lighter shades, the lightest shade, where fewer than 20% of households are housing cost burden. And in fact, if you look at places like Buncombe County, Mecklenburg County, Durham County, where I was yesterday, there are significant numbers of people that are housing cost burden. So more than 30% of the population is spending more than 30% of their income on housing. But it's really staggering. If you look at these maps, you can see in North Carolina, there are 4 counties with less than 20% of the population that are housing cost burden. And in South Carolina, there's just one, right? South Carolina was certainly not thought of as a high cost state, right? That has really changed in some of those metro areas. And then in the lower income parts of the state, they still have issues related to this, right? So we can't go anywhere without hearing about housing. And it really is, the price inflation is fundamentally about low supply. We hear this all the time. So like I said, it might be low supply of land in a more urban area. In a more rural area, it just might be a lower supply of quality housing. But housing is really an issue. And so if you look at the total vacant housing units, you can see how low those numbers are, because that graph on the left does not adjust for population, right? This isn't a percentage. This is the total number of vacant housing units. So you can, think like now the level right now of vacant housing units is about like it was in kind of the early 1980s, but think about how much larger population is right now. So very, very low housing supply. And the reality is, since the Great Recession, which you can see that period of time, what happened to housing starts, both single and multifamily, during that 2008, 2010 period, it really, it was so destructive to housing starts and permits. And we just have not ever recovered even to the 1990s average of building houses. So really, in the communities that we go to, I would say almost all of them report that they are just not building enough housing units to support the folks that they have there, and certainly to provide enough supply to where prices come down or grow at a slower rate. I do want to talk about employment. This is super important and an area where much of North Carolina has done quite well. So if you look nationally, we are well above pre-COVID levels of employment. We have not gotten back to the pre-COVID trajectory, which is that dotted line. If you look at the month-over-month numbers to normalize those numbers, we really need to add about 80,000 jobs, probably 60 to 80,000, somewhere in that range a month, to keep up with population growth. So any number above that would be thought of as expansionary, so the economy expanding from an employment point of view. Below that would be thought of as contractionary. And really, the only month we've had that has not been a pretty good jobs month in the past 4 years was October, and that was when the hurricane impacted employment numbers. So as a reference, these surveys are done as of the 12th of the month. So the way the questions are asked is, of the 12th of October, did you have a job or not, basically. So that's why the hurricane happened, I think it was September 26th, 27th, if I remember correctly. But it didn't show up until the October report because the September 12th was pre-hurricane. So if you look at North Carolina has exceeded that pre-COVID expectation. The slope of the growth of this employment curve, especially through 2022 to 2024, very sharp, very steep compared to most states. But you can see in October, North Carolina lost jobs, certainly due to the hurricane. Now, the job losses from the hurricane are very interesting, and I know some of you guys on this call are in Western North Carolina, but it's really interesting, right? Because the types of jobs that were lost right away are different than the types of jobs that might be lost from a longer term perspective. So, for example, in that October jobs report, one of the industries that took a huge hit was construction. Well, if you think about construction, just a few weeks after the hurricane, any construction on, let's say somebody was building a house or building a new facility, it's reasonable to think that paused or stopped entirely for a period of time. So construction workers might have been out of work. But certainly as the rebuilding process has happened, there's a ton of construction going on now, right? So immediately construction jobs lost, but then over a longer period of time, many, many construction jobs gained. Much of that'll be temporary though, right? Because hopefully we're able to build many things back, repair things, and then there'll be kind of a right sizing again. But it is really interesting to see what types of jobs grew in those areas during that period and what types of jobs went down. Specifically in Western North Carolina, we wrote a piece about Hurricane Helene, and it was mostly jobs in construction, leisure, and hospitality that were hit the hardest right after the hurricane. If you look at North Carolina, and again, this is a slide I always show, so those of you that see me present before, you've kind of seen this over time, and it's been the same story since right after COVID hit, which is that the Carolinas have recovered employment much better than the other states in our district, or geographies, I should say, because one of them is Washington, D.C. But with this graph indexes employment to 100 on the left-hand side, so it looks at the number or percentage of jobs that were lost right when COVID hit, and then what jobs were added back. And you can see that North and South Carolina, really by the middle of 2021, towards the 2/3 into 2021, had added back all the jobs that were lost. Now, these were not the same jobs, right? Things changed during that period of time too. So it doesn't mean that a job was lost in leisure and hospitality and gained in leisure and hospitality. It might be the job didn't come back to leisure and hospitality because they had automated, right? They had done things in the meantime to where they didn't need that job, but instead a job showed up in business and professional services or warehousing and transportation, for example. But you can see that in the 5th district, we have 2 geographies that still have not recovered to pre-COVID employment. So that's Maryland and the District of Columbia. This is very hard on these places where they are not back to that level, because in some of these places, Maryland specifically, this year will have an issue with their budget, meeting budget, because tax revenues are down. So it's very challenging to live in a place that, from a macro group point of view, from a state point of view, are not growing. So I know sometimes those of you that are in more rural area parts of the state might not be experiencing the same type of growth, but you still do get benefits from the state growing as a whole, right? There are higher levels of state tax revenues, for example, that can be used in many projects across the state. So you can imagine being in a rural place that's maybe shrinking more rapidly in a place like Maryland, where the state is also not seeing growth in revenues, is can be very, very challenging. Speaking of that, I mentioned that the growth is not evenly distributed, and this really shows that. This is employment change from February 2020, so pre-COVID, until the end of December. And Raleigh has, almost through this entire period, outpaced the rest of the state. But you can see there are some other large MSAs that have also grown quite well. And then there's places like Jacksonville, right? So that's a very different type of employment that you're seeing in Charlotte and Raleigh. But Jacksonville has seen very impressive employment growth. Same thing with Burlington, right? But just because these numbers are the same doesn't mean are similar to each other, like a Charlotte and a Durham, for example, that doesn't mean they present the same or they feel the same on the ground. A lot of this is impacted heavily by industry. So if you are in Raleigh, for example, if you spent much time there, there's been a ton of growth in life sciences, tech, biotech, kind of in that realm. Those jobs tend to be very high income jobs. So when I'm personally in the Raleigh area, I'm really struck by the high-end restaurants that are coming in and the high-end apartments that are being built, and kind of the growth that's occurring amongst higher income families. Now, those families also demand a lot of goods and services, and so that also brings in more hair salons and dentists and lawyers and all the other products and goods and services, grocery stores, right? Things they're consuming. Charlotte, the growth in employment has been more in advanced manufacturing and in financial services. So still great jobs, family sustaining wages, right, in many of these careers, but not the same wages as some of these jobs that are coming into Raleigh. And so it can feel quite different. Another thing I'll point out is that population growth does not always equal employment growth, right? There are places like Asheville that have grown a lot in terms of population, but many people who move to Asheville move there to not work, right? We have a lot of retirees that move to that area. And there's also more like remote workers that maybe don't show up in the data the same way in Asheville. And so even though they're seeing decent population growth, their employment may not be growing at the same rate. But it is interesting to note that all but Rocky Mount have seen employment growth during this period of time. And then if you looked at in a lot of other states, there's a lot of metro areas that have not seen employment growth. So this is a real positive thing for North Carolina, and one of the reasons why it continues to be on the list of kind of fastest growing places. Reality, though, is that labor is still pretty tight, especially in a place like North Carolina. This models worker demand and worker supply, basically. So the gray line is labor force, the dark blue line is worker demand. And until about 2017, the way things normally were, unless you were in a recession, was that there were more people in the labor force. And the labor force, as a reminder, is the number of people who are working plus the number of people who aren't working but are actively looking for work. So there were more people in the labor force than there were jobs available. So, think back to 2011 that you see there. And if you had an employee that wasn't really pulling their weight, they weren't doing a great job, they could be let go. And in theory, there are a good many people who are looking for jobs or looking to change jobs. And you might be able to rehire that person pretty easily, hire somebody else. But things changed in around 2017 when all of a sudden in North Carolina and many other states in the country, and actually this happened in the national point of view in 2018, but all of a sudden there were more jobs than there were people in the labor force. This is a very different scenario, right? In this scenario, it might be much more difficult to hire. One of the things that we've seen recently in our outreach is companies appear to be like are more hesitant to let employees go because they know it's harder to hire now, and it has been for the past few years. It's hard to find people with the right skill set that are the people you want for the position. And so in this environment where the number of jobs available is above the labor force, this creates higher wages, right? Which we've seen, and it does create a very tight labor market. And the reality is it's likely to stay that way, and in the near future, unless we have a decline in demand for jobs or demand for workers, so like a recession. We are seeing, though, that labor market flows are normalizing. What do I mean by that? We had an extraordinarily high job openings rate back in 21 and 22. That has come down to normal levels, kind of where it was before COVID. At the same time, the hires rate has gone down and is now really back to a relatively low level, even compared to it looks like it's down about to where it was in around 2012, 2013. And the quits rate has normalized. So the quits rate was also very high. So at one point in time, there's a lot of jobs posted. A lot of people are quitting their jobs. The hires rate is pretty high. That has normalized. But interestingly, we are not seeing a lot of new unemployment insurance claims. Now, I did not look at the new numbers would have come out this morning, I believe, and I did not look at those. It would be interesting to know, and actually I'm going to look it up as I'm sitting here because I have been wondering if we might see them go up this week. They normally come out yep, here we go. So they did go up today. So they come out every Thursday. And this article from Reuters does say that they increased to 219,000. But let me point out to you, if you take this back like decades and decades, these unemployment claims that we've seen over the past few years are extraordinarily low. And once again, this does not adjust for population growth. So even a level of 219,000 is thought of as very low. So it will be very interesting to see what happens over the next few weeks, especially like the federal labor force is a big group of people, right? There's a lot of people that work for the federal government. There's a lot of government contractors and people that work in government adjacent businesses. So it'll be really interesting to see soon. All right. I do see a question here that I'm going to go ahead and address from John because it is actually, John, I'm going to hold off on your question for 1 minute because I want to wait till I get to one of my next slides, but it's a really good question. So I want to answer it, but I've got another slide that'll be good. So one of the things that hasn't recovered is labor force participation rates. They still lag pre-COVID levels, and the estimates from the BLS show that they are expected to decline to 60.4% by 2032. I like to take this graph all the way back to 1948 because in some ways in post-World War II, we were in a situation where we had high demand for goods and services, but relatively constrained labor supply. I feel like we're in a similar situation now in some ways. And so I like to see this pattern of kind of what has happened to labor force participation rates over time. And labor force participation rates is the percentage of people age 16 and older that are either working or actively looking for work. That big increase you see from the 60s to the 90s was driven by two things: baby boomers becoming a working age population, so big generation of kids becomes a big generation of workers, but also women entering the labor force in massive ways. But this number's been falling since 2000. Most of that decline, close to 70% by many estimates of that decline, is about what we might call the graying of America, right? People living longer, having longer periods of retirement. But there have also been other trends that you can see in the data. So specifically, male workers without college degrees, and specifically white male workers without college degrees, have seen relatively steady declines in labor force participation rates since that time period. And so some of this also is about culture, it's about work habits, it's about generational change and things like that. I could talk another whole hour on that. But a lot of it, like I said, is driven by fertility rates. So if you look, so we've got this situation where we're having the graying of America, people are living longer, having longer periods of time, and that is a giant percentage of the population now, right, that is moving into kind of either the late working years or retirement years. And fertility rates have just remained extraordinarily low. So this shows the baby boom. You can see it there from the mid 1940s until, I think the baby boom rate is 45 to 64 in terms of birth years. And then you can see this steady decline. You know, typically there were kind of peaks and valleys that would come off of fertility rates, but really since 2007, we've been in a pretty significant decline. Now, why is that important? Well, first of all, if people aren't having enough babies, then, and in theory, let's say we aren't allowing immigration, then we could have a situation where eventually the population declines, right? But also, if you look at that 2007 kind of bump up in fertility rates, and then after that it goes down, that is leading to what is oftentimes called the 2025 cliff. This has been talked about. I worked in higher ed for many years. I would say by 2010, we were already talking about the 2025 cliff. The concept of the 2025 cliff is 18 years after that increase in fertility rates. After that, the number of high school students graduating from high schools in the United States declines every year after that because of these declining fertility rates. So essentially, until this year, immigration has been able to kind of cover up for the declining birth rates amongst children. But starting this year, we expect that decline to begin. Now, that's going to hit different places differently. I heard the president of the community college system of Maine last week say, you know, you guys talk about the 2025 cliff. We've been living this for many years because Maine is the oldest state in the country. And so this hit them earlier, right? A younger state like North Carolina, it's going to hit later. But from a national perspective, this is important because this impacts workforce, right? It impacts higher ed as the number of 18-year-olds begins to decline nationally. I did see an article yesterday or the day before that said fertility rates from last year were even lower than expected. So it's just interesting, right? People are having fewer kids. Why are they having fewer kids? A whole host of reasons. But certainly if you look at the survey data on this topic, it is about the cost of childcare, right? It is about family formation occurring later. So people are living at home longer, not forming families as early. It is about all sorts of different things that are occurring that are causing cost of housing, right? Cost of housing is certainly part of it. So lots of different things. But it isn't the only trend. And as I mentioned, you can see in the data some patterns of where labor force participation rates are declining. So if you look here, you can see the real decline is amongst those 55 and older. After COVID, it took a big hit. A lot of people retired. So these are mostly baby boomers who were like, you know what, I'm done. That took a big hit and it has just never tried to recover, right? And we knew this was coming. We knew the baby boomers were going to be retiring, but this kind of accelerated some of that. But you can also see some declines amongst college grads, but certainly amongst those who are high school grad, no college, where the labor force participation rates have fallen quite a bit. I do want to point out, and this relates to your question, John. So John's question is, with the threat of a tighter labor force and the president's policies to increase the crackdown of working illegal immigrants, do you think it could cause hesitation on additional capital investment or company growth in North Carolina and the U.S.? Okay, the reason I wanted to wait for this graph was I want you to look at that increase you see there of labor force participation rates amongst 25 to 54-year-olds. And I'm not going to go too much into this because we don't have time, but you can Google this and read more about it from some good sources. But a decent amount of that increase is actually amongst immigrants. One of the things that happened over the past few years that I understand was a change, but I don't directly quote me on that, but people who came in the United States that were waiting, that were claiming asylum, that were waiting for cases, were given work permits. So those folks were able to legally work in the United States. And you can view that in the employment data, that change. So certainly a reversal, backing up off of that, and reversing it would impact employment. The question is how much, right? There is no doubt that certain sectors have high percentages of undocumented workers. So, for example, on broad sectors, construction, leisure, hospitality, agriculture are the top three. I think it's agriculture, then construction, then leisure and hospitality. But then even within those sectors, there's certain subsectors that are hit harder. So, for example, in construction, the top one is roofing. I think the second one is drywall installation. And so, 40% is the estimate. 40% of roofers in the United States are undocumented. If in theory they were no longer here, it makes sense that there's issues in the roofing industry, right? And that prices might escalate considerably. I think that, so my answer to your question is that I think it depends on what industry you're in, A. And B, I also think it depends on the size of the crackdown and how that actually happens. Right now, we have not seen a huge number of people. If you look at kind of the daily numbers, it's not like everybody has been sent out of the US. But certainly this is something that economists are paying close attention to, because it does impact the economy, certainly. I did see a question too from Kathleen about that she read in 2025, 73% of the workforce will be millennials plus the alpha generation, which I don't know, Kathleen, is the alpha generation the same as Gen Z? Do they call it both? Maybe, I'm not sure. So I have not seen that exact study. However, one thing I will say is that there are clear changes in employment. And I look a lot at kind of what's going on in the workforce and look at survey data and other data around that. And it is really interesting to see how work is changing, right? So this is not just remote work. This is not just about remote work. This is not just, I want to have more flexibility. This is a kind of wholesale change in the way people want work to play a role in their life, right? And some of it is very unusual to us that are older, because some of these work opportunities did not exist previously, right? I mean, I have an 18-year-old son, as an example, who is open to business selling sports cards. Not expensive sports cards, pretty cheap sports cards. And he has started this business, and he does these live streams on an auction site selling sports cards. He can make more. He actually has a typical job too, but he can make more money in 1 hour selling sports cards sometimes than he can working 5 or 6 hours at his more traditional job. So things like this didn't exist when we were coming along, right? So this can be very, anyway, for me, maybe not y'all, it can be disorienting, right? It's very different. And so understanding how younger people work and the expectations they have is very interesting. And it is something that all companies are going to have to deal with, because if that stat's true, right, then this is the majority of the workforce is now younger. I did also read something very recently that was very interesting, that said that baby boomers are working. Typically now, baby boomers have worked more years than older generations. So some of them are still retiring early, right? But others are working longer. And thus far, it looks like Gen X. So I'm a Gen Xer. Us Gen X folks are retiring a little earlier, which I hope that's the case for me, maybe. So I was reading that typically there is about a 20-year gap between retirement years in a generation, but that they expect it to be much more narrow this time, which is interesting, I think. Lots of interesting things going on in labor. That never gets old thinking about that. Let's talk about quickly before we move to questions about inflation. Inflation has gone down a lot, right? If you look at how much inflation has come down, if you look at the Fed members, those FOMC members, their predictions from a couple years ago, it came down faster than they expected. So this is great news. Inflation has come down faster than they thought, but It's not over yet. We are not to 2%. So, our president, Tom Barkin, was out there talking today, making some comments. I saw Raphael Bostic out of Atlanta, Fed, was making comments today too. You can go read what they have to say, but what they'll say is, we're getting it to the 2% target. We're not there yet. We're not giving up on this thing till it's done. And part of that is because inflation is a really tricky thing to tame, right? And it's destructive to an economy. It's a terrible tax on consumers. And so they are really committed to that. I mentioned I would show you kind of the change in inflation over time, though, and you can see that orange, which is goods, that was a lot of a big part of inflation in the early days of inflation. But you can actually see goods now are deflationary, which means on average the price of goods has actually been going down. But you can also see, if you look at the blue line there, and the yellow, services and shelter, the combination of those two is a much larger share of inflation than it was if you look all the way back before. So shelter costs have continued to climb. So this is rent and owner imputed rent, and services, like I said, have made up in the kind of later part of this inflationary period, have been a bigger part of inflation. So what about Fed funds rates? This shows you the expectations of those 19 FOMC members. These are called the dot plots. If you don't know about the dot plot, you should be looking at it. A new one will come out at the next FOMC meeting in about 5 weeks. We are currently where the red arrow is. I want to point out two things to you. Last December 2023, or December 4 last, if you look at the 2025 estimate, or 2024 estimate, we ended up lower than they thought we would, than the median member thought we would. And that's because inflation came down faster than expected, right? So that's great. But then if you look at 2025, now the median member of that group is expecting about a 50 basis point cut. So that could be 150 basis point cut or 225 basis point cuts between now and the end of the year. These dots are as of the end of the year. In 2023, in December 2023, they thought we would have lower interest rates by the end of 2025. The median person did. So this is because we have seen kind of this stalling out of the decline in inflation. It's not stopped, right? But it's just slowed down the rate at which it's declining. But I'll also point out to you that longer run view has also changed. So the longer run view is ticking up. So what does this mean? That longer run view is sometimes called the neutral rate of inflation. This is the rate that they think we need to be at in order to keep inflation, what rate the federal funds interest rate needs to be at to keep inflation at 2%. Last year, at the end of 2023, the median member thought it would be 2.5%, and now the median member thinks 3%. And if you look at the trend, so these are of December in every year since 2013, and you'll see that between 2019 and 2023, it was sitting at 2.5%, and now it's back up to 3%. It has not been 3% since 2018, but I want to show you this to point out, it's not like we haven't been here before, but I do also point this out to remind you that when we had a 3% mortgage interest rate, the federal funds rate was at 0, right? Federal funds rate was 0 to 0.25%, that range. And mortgage rates were in the 3 to 4% range. So what they're telling you here, though, is that they think they need to go to about 3% to keep inflation at the 2% target. So, expecting it to go to 0 again, that would not be in my set of expectations based on what the FOMC is telling us. Now, of course, these things can change based on recessions and other things that could happen in the economy, but this is what we're seeing right now. So to close up really quickly before we go to the other questions, the growth has remained really strong. And that's especially true if you look at it from a macro point of view, right? So that doesn't mean some people aren't struggling. There are plenty of people that are struggling. But from a macro point of view, growth has been strong. Certainly true for the state of North Carolina, certainly true for most of the metro areas in North Carolina, not necessarily true in the more rural parts of the state. But there are some really significant speed bumps ahead, and right now the uncertainty is absolutely at the top, and this is fiscal and executive branch policy uncertainty, monetary policy with the Fed. The Fed is deeply committed to our 2 mandates from Congress, which is keeping prices stable and working towards maximum employment. So we have to take whatever happens on the fiscal side as given. But it's difficult to set monetary policy if you can't make expectations, if you can't set reasonable expectations on what's going to happen on the fiscal policy side. So that is tough right now. Also, geopolitical issues, if inflation did pop up, that would be really concerning. But once again, the FOMC members are being very transparent with what they are planning to do, which is to get us back to the 2% target. So what I think about is, are rates restrictive enough right now for us to get there? Most of these FOMC members are saying they think they are, as long as there aren't other big changes. Is this idea of a soft landing really possible? When will additional rates cuts come? Unfortunately, I don't have the crystal ball to know all of that. I do think there will always continue to be winners and losers. There are always going to be parts of the country that do better than other parts, or parts of states that do better than other parts. I think the Carolinas as a whole, most of the things that are causing strong growth in the Carolinas are not going to change. But there will be some parts of the state that will face continued challenges. And so it's really important not to lose sight of that just because other parts of the state are doing so well. Last thing, I have an ask of you. I know many of you on here, because I saw the list of who's attending, own small businesses or are leaders of larger businesses. If you are an executive or an owner of a business, we would love to have you participate in our surveys. These take like 5 minutes a month to do. They do not take a lot of time on your part, and it helps us tremendously. We use this data. Read every comment that people leave. Sometimes our survey director will joke and say, if you've ever wanted to tell the Fed what to do, this is your opportunity to tell us what you think we should be doing, or what you think Tom Barkin should be doing. But we read every comment. We look at these results every week, every month, and this allows us to help Tom prepare for those FOMC meetings. So this is a tremendous help to us for you to participate. So please, you can text survey to 55444 or scan that QR code, and we would greatly, greatly appreciate it. Timothy, I'm going to leave that up for just a minute so people can scan it, but I'm happy to take some of these other questions.
Thank you, Laura. As always, we appreciate your knowledge and experience being shared with us. And there's a lot there for us to digest, but again, appreciate it. You all have already started putting some questions in the Q&A. Thank you. We do have a couple here, Laura, and I guess I'll read this one because I think this one has sort of not been answered yet. But it says, you mentioned real consumption remaining strong, but we are seeing sales tax revenues level out and flatten in our metro NC County and others across North Carolina after steady growth for many years. What do you think explains this?
Yeah, so some of this is that shift from goods to services. So not all services are taxed, right? Many are not taxed by the sales tax, and so that is part of this. Is that when it's goods, it's really easy to slap a sales tax on that, but services are more difficult. So I think that is part of the story. I also think in some counties you are seeing some starting to see some leveling out, right? Sometimes you'll hear the term "trees can't grow to the sky." Like people just can't continue to just spend more and more and more and more forever. And so we may be seeing some of that as well. We are seeing like credit card delinquencies tick up some, not to like anywhere near Great Recession levels, but seeing some ticking up there. So I wouldn't be surprised if you saw some leveling out of real consumption growth. Like I said, one of the reasons why I always show that graph is because as an economist, as somebody that taught economics for 17 years, that is just staggering to me that in the face of 21% inflation, people are putting more in their card. I mean, I would have thought that was impossible, but once again, we had all this stuff. So part of this is that excess savings has run out. Part of it is that maybe there might be some uncertainty where people are pulling back too. That is a really interesting question though. And then the services, the untaxed services too.
Thank you. We've got one other one here. Do you look at housing units that are entitled but not constructed?
Okay, so it says it seems like there are thousands of entitled units not being built that would significantly address supply issues in metro areas. Many policy solutions that are offered seem to focus on density and buildable land supply, sometimes at the cost of industrial lands, but that seems to be missing the underlying causes for the lack of supply. Yeah, this is a great question. So we talked to a lot of people in this space, and I will say that if I had a nickel for every time somebody talks about the difficulty in lot development now, so when I say difficulty, I mean everything from the speed and cost of the permitting process, and the development standards that exist in some communities that say you have to have sidewalks on both sides of the street, or you have to have all these different covenants and restrictions and stuff. So that has made it extremely expensive to even get started in building. The other thing is there's a lot of projects that get proposed that especially you mentioned that there's a lot of things that are trying to focus on density, but I was just talking to somebody yesterday in the lower part of South Carolina. They've been trying to get through just a 3-story multifamily unit for now years, that keeps getting every time it comes up in the planning councils and stuff, people come and complain, and they delay it. So the interesting thing about housing is much of the issues with housing supply are decided at the local level. Housing is something that is not really federally doesn't have the same federal regulations that many other things have, so a lot of the issues are local. Saw one more pop up too, I think.
Yeah, do you want to answer that one?
Yeah, so tariffs. So, tariffs are tough. Research shows for sure that if you have tariffs, prices go up and output or GDP is restricted. The question is how much? The question is how much. And one thing that's interesting about something like tariffs, and this is true with some other policies as well, it's somewhat true with inflation. Like, we just don't have a lot of real life examples of it to know exactly what happens. Right? Like, we know in theory as economists kind of what we believe would happen. And you'll see a lot, in general, if you look at economists, they tend to be more free and open trade because of this. But we don't really know to what degree, because it highly depends on what the retaliatory tariffs come in on the other side. Are there easy to substitute options in other countries, right? So if there are tariffs in China and Mexico, and China, Mexico, and Canada, and they retaliate, can I easily get that product from the UK now cheaper, or Germany, or the Philippines? Or is this something I have to buy from Canada, and so it's going to cost me a lot more money, right? So it hits different industries very differently. But certainly the literature and the evidence shows that you would expect to see some price impacts and some GDP growth impacts.
Thank you. Well, I don't see any additional questions, and I think it's probably time for us to wrap up. So, Laura, thank you again for your insights. We always appreciate you sharing with us, and I encourage everyone to, if you're in a position to complete the survey, do that to help out. But before we go, I'd like to remind our membership, our webinar guests, of some upcoming events. We'll host another webinar next week focusing on innovative childcare solutions. It'll be held February 11 from 10 to 11 a.m. via Zoom. Our next new member orientation will be held via Zoom on February 25 from 9 to 10 a.m. The 2025 Site Selectors Summit and Spring Conference will be held March 2nd through 4th at the Pinehurst Resort. We had to postpone our Emerging Executives Forum last month due to weather, but it is rescheduled for April 9 and 10 in Durham. So keep a lookout for the emails around that. Registration is open for all these offerings. You can visit the NCEDA website or check your inbox for more details. We also want you to save the date for a few more events that'll be happening later this year. The legislative breakfast will take place on March 26th, and we'll host 3 regional networking luncheons in April and May. Eastern will be on April 17th in Greenville. The Western will be on May 9th in Asheville, and the Triad will be on May 20 in High Point. So thanks everyone for being with us today. Thank you again to Laura for sharing your knowledge, and we hope everyone has a wonderful day. Thank you.
Bye. Thanks so much.
Bye.